Hi, folks. Welcome to this special episode. So, today we will discuss a case study about investor behavior and how people react at market highs or on corrections. And in my experience, I think making money from the market is less dependent upon strategy or even how much the market goes up or down, but it is more to do with how we behave in those situations. So, for instance, let's start with, let's say, a chart like this where markets are continuously going up, and the most popular, the most frequently asked question when markets are at all-time high is that, can I buy? Can I wait now? Will the markets consolidate? Is it too risky to buy now? Will there be a consolidation now? So, this entire, uh, sort of intent to try and time the markets. Let me buy when there is no chance of going down. And that point never comes, even in corrections or at all-time highs. There cannot be any point where you will feel that there is uh, no further down move possible. When markets are correcting, buyers move back and price falls. When markets are advancing, buyers move forward, sellers move back, and that is why price moves goes up. So there is a natural cycle between overbought, oversold markets, overowned, underowned markets. So that pendulum continues to rock, and it rocks with a very uneven frequency. So in a pendulum, of course, you know that every second it will be here and the next second it will be there. But in markets, the underowned, overowned, underbought, overbought zones are not apparently clear, and and hence very difficult, almost impossible for anybody to try to buy the bottom and sell the top. That is a wishful sort of outcome of the market for most people. uh, so let's go through Nifty's journey of bottoms and recoveries, and see how things went around in the last many decades. So we've identified significant 8 bottoms of Nifty since the last 35 years. And you will see that there are patterns which will emerge out of these data points. So the first bottom was in April 93. This came after the huge rally of Harshad Mehta stocks. Market actually went up many folds before this top was made in April 92. And then for a year, the market declined. The market declined by 53%. So imagine Nifty declining 53% at any point of time within a year. But what happened within 6 months of this? Market was up 37%, and within 1 year, the market was up 94% back to where we were. So there was a several X move of the index, and then a 2 year delay of any furtherance of that move, but back to square one within 2 years and 10 months. Uh, Next was in December 1996, where you also had some currency crisis, and some Asian markets were weak. You had a drawdown of approximately 45%. Um, Within 6 months, you were up only 39%, and 1 year was flat at 14%. Recovery of this entire drawdown took about 5 years. So there can be periods where markets will be exactly like a patient in ICU where nothing is working, but there are incremental boosts and falls. So gradually bringing in your capital at each level, uh, sipping through the market, having your strategy churn through different industry sectors which are in cyclical mode helps in these types of periods. Nobody makes a big money in these types of periods. Then, of course, the dot-com boom came around from 99 till beginning of 2000, and markets crashed post that. Again, a 53% drawdown. Within 6 months, you had a recovery of 33 months, but it gave it back mostly. And post 1 year from the bottom, you were still just 14% above. And the entire recovery took 2 years and 10 months. So reasonably long recovery period right here. Then there was elections in 2004 and India shining BJP campaign was lost. You had a drawdown of 35% from the recent high. 6 months you were at 45% gain from the bottom, 53% within 1 year. Recovery, overall recovery took 11 months. Quite fast actually, given that scenario. Then you had another one in 2006. This was a, you can say, a natural correction in a overall emerging market bull run. Uh, and you had a again a 31% drawdown, a full recovery within 5 months actually. So in 6 months you were up 45%, in 1 year you are up 60%. So what you're seeing is that drawdowns after a rally are reasonably significantly large, 30, 40, 50%. And most of the times when the drawdowns are deeper, the recovery is equally sharp. This was, of course, the GFC, where the drawdown was 65%. Within 6 months, you had some 42% gain from the bottom and 108% within a year. But it simmered around the top lip for a long period of time. And it took 6 years and 2 months for this high to get broken out. That was 2008. Then you had another one post demonetization. A general trend of fall was there, and demonetization kind of crystallized that fall deeper. And you had a entire sort of a drawdown of 25% to be recovered over 2 years, with 29% and 30% recovery in 6 months and 12 months. And then, of course, you probably all remember the COVID fall, where markets dramatically fell about 39%. Within 6 months, most of the gain of the loss was regained, and in a year you were actually much higher at plus 93% from the bottom. Entire recovery taking 11 months, where markets were called to be having gone into a recession or a deep drawdown for years together. Nobody was expecting that in 11 months you would be having a new high on this. So that's the nature of the markets, where you may be expecting a very sharp, short recovery. It may take years together. You may be expecting very long recovery. It may recover in very short period of time, because nobody really is able to predict how the market moves. It is all, whatever we hear on TV or on media or so many experts, nobody can really say anything with any consistency. 80 to 90% of managers are wrong in terms of their forecasts. If you were to collate all their forecasts of the last 10 years, you will find that 80, 90% most people are wrong. Of course, to say that market will rise over the next 10 years is a no-brainer, right? But to really predict market falls, to really predict how deep a market will fall, how they will recover, is very, very difficult. So these eight instances, you can see that the average uh, drawdown uh, uh, was within 25 to 55, 53% kind of range. Once we have 65 also. So a market which falls 10%, 5%, 20% is not even, it is not even a proper correction in that market. And to sort of put the picture in perspective, in the last 4 years since COVID, we've not even had a 10% correction at any point of time. So from that perspective, there will be periods when there will be sharp corrections. We will have to go through these kind of corrections at some point of time, and that will be the true test of whether you are in for the long haul or are you afraid of holding on. And to give confidence to such deeper drawdowns as and when they will happen, that within 6 months on an average, that 37% gain is made from that bottom. Within 12 months, 58% gain is made from that bottom. And within 2.5 years, you will recover from the worst of falls on an average, at least. So the thought that, if you are in the market for 5, 10, 20 years, but then if you hit a roadblock for a couple of years, or 2.5 years on average, it's not such a bad deal, right? I mean, if you are aiming to get a high double digit, let's say high teens outcome of the market, and if you have to suffer some pain to go through that, it is, I think, well worth that much effort. And that is why you will get that return, because that is the reward for your taking the pain. If there was no pain in the market, why are you getting rewarded? I mean, if it was risk free, everybody will want it, right? But the point is that you are in the market, you are taking a risk, and that is why you are getting rewarded if you bear the pain of that risk taking. But a lot of people are unable to do that. So what is the most common mistake? You enter at the top and you exit at the bottom. This is the most common mistake, or the common eventuality many investors go through. And those who are, able to overcome this cycle, even if you have entered at the tops, if you have a a plan to, keep stocks that are doing well, exiting stocks that are weak, then you will not bother with the market bottoms as such. Because if you are with the most defensive stocks when markets are coming down, then your portfolio likely will not be hitting rock bottom at that point of time, because you will be out of those stocks which are falling like nine pins. So this is the most common mistake, that you get it complete FOMO, and you buy a stock, when everybody is exhausted, they're buying, and you have a complete fear syndrome, and you exit the stock at at the rock bottom. uh, that's there. So period following a bottom is usually profitable. Of course, we will come to know that a market has made a top or a bottom much later than it actually does. So you will never know. For instance, today, if Nifty is 23,600, and let's say if this is a top that we are making for the next 6 months, we will not know until after many months from today whether that point was a top or not. So today you cannot say whether you're sitting at a top or not. It's only once it is made, and you actually, see that pattern, that you can really say that, okay, that was a top that was there, or that was a bottom that was there. But the pullouts from the bottom are extremely profitable, of course. And the classic example in this sort of behavioral issue that most investors have is that example of Peter Lynch. You may have read his books also. The most popular one is One Up on Wall Street by Peter Lynch. If you haven't read that, you must read that. Peter Lynch was the star fund manager in US markets. He ran a fund called the Magellan Fund, and he ran it for about 13 years between 1977 and 1990. And he delivered an astounding 29% CAGR during those 13 years. I mean, imagine large fund, 29% CAGR over 13 years. I mean, who would not want to be in that fund, right? So everybody is attracted to that fund. Now, according to Fidelity Investments, the average Magellan Fund investor actually lost money during his 13 years. I mean, you can, be shocked to read about it, but it's a fact, and it is all happening due to investor behavior. So while the vehicle which people are choosing is creating 29% CAGR, but their own behavior in terms of how they're getting in, how they're getting out, how they are placing their bets is making that difference. So the reason, the way in which people lost money, and most of them, is that Peter Lynch had exceptional years of performance within those 13 years. So all 13 years were not 29% CAGR. There were some years of 80% gain, and there were some years of 40% losses also. So for instance, in 1980, this fund returned a staggering 80% return. So seeing this return, that there is one Peter Lynch and there is a Magellan fund, and this fund last year has done 80%, lots of capital moved to this fund. And in Indian context, in the last 3 years, we are seeing that there's a lot of capital that's going to one, two, or three funds like this. And what happened the next year, the fund didn't perform so well and actually fell down. Uh, all this money that came in with the expectation that, this has done 80% last year, so next year also it will do, if not 80, 60, 50, 40, something. But nobody was expecting that next year will be a loss year. And then next year, when the fund made a bigger loss, most of this hot money that had come in actually went out. So they came in at the top, and within a year or within 2 years, when the fund didn't perform, they went out. And the years after that were again, you had another set of good years after that. So this cycle of rinse and repeat keeps happening in the markets. And this is the main reason why we see the ups and downs and the bottoms and tops of the markets and in stocks, because what is actually the meaning of a stock going up? It just means that there is more demand of buyers and there is not enough supply. That is why prices are moving up. And on the other hand, when there is more supply and less demand, prices are moving down. It is actually as simple as that. We can build all kinds of narratives around this simple phenomena, but that is what is actually happening in the market. Liquidity comes into a particular stock, particular market, particular sector, it goes up. Liquidity moves out of that, it moves down. That's the basic simple physics of the market. So can we expect a correction now? We've seen markets go up almost non-stop since the last 7 months. We don't know. I mean, this could rally for the next 2 years and then collapse. It may rally for the next 5 years and then, may have a correction. It may have a correction starting tomorrow. You can't expect that, and you should not be trying to time it. As long as you have a strategy which is self-correcting, self-healing, sectors are self-selected, then why would you want to worry about it? We know that India growth story is solid, and the runway is there for next 10, 20 years easily. So why should we be worried about a 2 month correction or a 6 month correction or a 1 year correction? Let the market do what it is doing. You should be clear about how you are going to behave when the market hits a correction or hits a bottom or is trying to recovering from that bottom. It is how, your stance towards the market should not be changing because of these shorter term noise things. Of the only thing that should be changing is that you should be remolding your portfolio as per the situation. If PSUs and public sector enterprise stocks have been running, you should be having that in your portfolio. If tomorrow media companies start to perform, IT starts to perform, you should be there. If on 6 months later, if FMCG companies are performing, you should be there. That's how you have to make the best out of the markets in each cycle, instead of getting stuck with those 5 or 10 names and saying that I'm going to bet on these 10 names, and regardless of what is happening in the market, I close my eyes, put my head into the sand and not worry about it. That market is not possible now. The world is a very disruptive world, and you don't know which, like you have seen in the last 2 years, which sector will actually do wonders going forward. So from a this rally that we've seen so far, I mean, we've already had a great retest of this bottom on the election day. We may again retest this, maybe if really things are hurting bad somewhere globally or something happens, we may test this. But that should not change your perspective towards the market or towards your ultimate goal that we are investing. Corrections are just part of the entire game. They are part and parcel of the game. They are healthy. Embrace them. Don't fear them. Corrections will help you create a lot of long-term success. And if we see the long-term sort of chart of the Dow Jones, I mean, this is over the last 130 years. We've had, uh, all kinds of issues, and you'll really need to zoom in to read if possible. But every few years, there is a geopolitical issue or a financial crisis, or even the Great Recession happened in that, COVID crisis happened in that. But what is the ultimate result? Ultimate result is that if you stick around with the proper behavior, with the proper mechanisms to stay in the market, you always made money. And that's what you need to do. Always make money and compound and be happy. That's all I have for this. Thank you so much. Goodbye.